Welcome to Index Orbit. In this lesson, we will learn how to use the OI profile and options levels indicator on the Dhan app to read live option chain data more intelligently. Think of the indicator as a map rather than a prediction machine. Horizontal bars show where open interest is concentrated at different strikes. A heavy call OI area can behave like a ceiling, while a heavy put OI area can behave like a floor. The indicator also adds max pain and an expected move band, giving us context about where price may trade and how far a move may be stretching. We will use one simple NIFTY 50 example throughout: price at 22,100, resistance at 22,300, support at 22,000, max pain at 22,100, and an expected move from 21,860 to 22,340. The goal is not to blindly buy or sell at a line. The goal is to combine levels, changing OI price action, and risk control. Let us build the map step by step. Start with the bars themselves. Open interest means option contracts that remain open, so the profile shows where contracts are parked at each strike. In our example, the call OI values are 120,000 at 22,200, 180,000 at 22,300, and 150,000 at 22,400. The largest value is 180,000, so the resistance strike is 22,300. The put OI values are 140,000 at 21,900, 210,000 at 22,000, and 160,000 at 22,100. The largest value is 210,000, so the support strike is 22,000. Red or pink bars represent call OI, and teal or green bars represent put OI. Longer bars mean more open contracts, not automatically a stronger trading signal. The resistance line is the strike with the heaviest call OI, where call writers may defend the market. The support line is the strike with the heaviest put OI, where put writers may defend the market. These are reference levels. They can shift as positions are added or unwound, so we should never treat them as permanent walls. Now use the two key strikes to define a default trading range. In our example, support is 22,000 and resistance is 22,300. So the range width is 22,300 minus 22,000, which equals 300 points. Current price at 22,100 is inside that range. Inside the range, mean reversion ideas may make more sense than chasing every small breakout. Near the edges, however, wait for confirmation. For example, if price approaches 22,300, look for a rejection wick, a reversal candle, or evidence that buying is failing before assuming the ceiling will hold. The same logic applies near 22,000. A level is a location, not an entry trigger. If price moves beyond an edge, treat that move as lower probability but potentially higher conviction. Do not immediately fade it simply because a line was crossed. First, ask whether OI is confirming the move. A genuine breakout may be supported by call OI unwinding, while a genuine breakdown may be supported by put OI unwinding. This range is your starting map for the expiry cycle, not a guarantee that price must remain between the two lines. A static OI level tells us where contracts exist now, but it may already reflect information the market has absorbed. For live trading, the more useful question is what changed since the previous reading. Refresh the profile periodically and compare the current bars with the earlier bars. At resistance, suppose call OI at 22,300 rises from 180,000 to 205,000, while price stalls below 22,300. The arithmetic is simple. 205,000 minus 180,000 equals an increase of 25,000 contracts. Price is not advancing and call OI is building. That combination suggests call writers are adding conviction, so resistance may be strengthening. This is often described as short buildup at the resistance area. It still is not proof. Check candles, volume, and the broader trend. The important habit is to read the direction of change, not just admire the longest bar. A large bar can be old information. A fresh increase or decrease tells us how positioning may be evolving during the session. Let us organize the 4 common patterns. First, call OI rising at resistance, while price stalls suggests bears adding conviction, so resistance is more likely to hold. That is our 22,300 example. 180,000 becomes 205,000, an increase of 25,000. Second, call OI falling at resistance, while price pushes upward, suggests shorts covering. If call OI falls from 205,000 to 170,000, the change is 170,000 minus 205,000, or negative 35,000 contracts. Falling call OI combined with upward price pressure makes a breakout above 22,300 more credible. Third, put OI rising at support while price holds suggests bulls adding conviction. At 22,000, if put OI rises from 210,000 to 235,000, that is an increase of 25,000, and support may strengthen. Fourth, put OI falling while price breaks down suggests longs covering. If put OI drops from 235,000 to 175,000, that is a decrease of 60,000 contracts, and a breakdown below 22,000 becomes more credible. These patterns are context clues. Always compare OI change with price direction instead of interpreting either one alone. Expected move gives us a volatility yardstick. In the example, the at-the-money 22,100 straddle premium is 240 points. So the lower boundary is 22,100 minus 240, which equals 21,860. The upper boundary is 22,100 plus 240, which equals 22,340. The expected move band is therefore 21,860 to 22,340. It is commonly presented as an approximate 68% probability zone for the current expiry, based on option pricing assumptions. It is not a directional signal, and it is not a command to trade when price touches the edge. If price remains well inside the band, volatility is behaving relatively normally, so ordinary stop and target sizing may be appropriate for your method. If price pushes outside the band intraday, the move is larger than options pricing anticipated. A counter-trend position may need tighter risk control, while a trend position may require a different target plan. Notice that our OI range, 22,000 to 22,300, sits inside the broader expected move band. The two tools answer different questions. OI levels describe likely structural zones, while expected move describes the priced volatility envelope. Max pain is another reference, but it should be used with restraint. It is the strike where option buyers, considering calls and puts together, would lose the most money at expiry under the model's assumptions. In our example, the calculated max pain level is 22,100, exactly where our current price sits. That does not mean price must finish there. Max pain can shift daily as new positions are added, removed, or rolled. Early in the expiry cycle, it may be noisy and should not become an anchor for every decision. Its relevance generally increases during the final 1 or 2 sessions before expiry, when the possibility of price being drawn toward a heavily positioned strike, sometimes called pin risk, becomes more meaningful. Even then, max pain is only a light bias. Compare it with support, resistance, OI change, price action, and volatility. In this example, max pain at 22,100 lies between support at 22,000 and resistance at 22,300. That placement can help describe the middle of the range, but it does not replace the range analysis. Here is a practical workflow for using the indicator during a live session. Step 1. At the start of the session, record the resistance strike and support strike. In our example, write down 22,300 and 22,000, creating the initial 300-point range. Step 2. Locate current price relative to expected move. Price at 22,100 is inside the band from 21,860 to 22,340, so volatility is not yet outside the options priced boundary. Step 3. Refresh the OI profile every 15 to 60 minutes, depending on your time frame and data availability. Compare the new bars with the prior snapshot and identify whether the nearest key strike is building or unwinding. Step 4. Combine the OI information with price action, such as rejection wicks, reversal candles, or strong closes. And consider volume and a trend or momentum tool, such as a moving average. Step 5. Near expiry, give max pain slightly more weight as a directional bias, but never allow it to overrule contradictory live evidence. This process prevents a common mistake, looking at one attractive line and treating it as a complete trading plan. The profile is most useful when it is refreshed, compared, and interpreted with the chart. Let us apply the workflow without pretending that the indicator predicts the future. Start with price at 22,100, support at 22,000, resistance at 22,300, max pain at 22,100, and expected move from 21,860 to 22,340. In scenario 1, price rises toward 22,300 and then stalls. Call OI grows from 180,000 to 205,000. A rejection candle and stable or rising volume would provide additional context for a possible range response, but your own entry rules must still decide whether any trade is acceptable. In scenario 2, price pushes above 22,300, while call OI falls from 205,000 to 170,000, a decrease of 35,000. That combination is more consistent with short covering, so the breakout is more credible than a breakout with call OI still building. On the downside, if price breaks below 22,000 while put OI falls from 235,000 to 175,000, the 60,000 contract reduction supports the idea that support is weakening. If put OI instead rises to 235,000 while price holds, support may be strengthening. The same level can therefore produce different interpretations depending on what changes around it. Before using any options indicator, keep the limits clear. Resistance, support, expected move, and max pain are not entry or exit triggers by themselves. OI-based levels can shift intraday as traders add positions, unwind positions, hedge, or roll contracts. A level that looks strong in the morning may be different later. Use this framework for market context and risk sizing, and confirm decisions with your own price action rules, volume analysis, and trend or momentum evidence. This lesson is educational and is not financial advice. The Dhan app may provide live option chain information, but the quality of your analysis still depends on refresh timing, contract selection, expiry choice, and disciplined interpretation. If you are opening a Dhan Demat account, you can use the referral code EJZZI96380. Please review all platform terms, fees, and risks independently before making any decision. Index Orbit is here to help you study market structure, not to promise outcomes. If this explanation was useful, like the video, subscribe to Index Orbit and continue practicing with historical data before relying on any live framework. Let us recap the complete method. First, read the profile. The largest call OI in our example is 180,000 at 22,300, so that is the resistance strike. The largest put OI is 210,000 at 22,000, so that is the support strike. Second, define the initial range from 22,000 to 22,300, with current price at 22,100. Third, calculate the expected move from the straddle premium. 22,100 minus 240 equals 22,860. And 22,100 plus 240 equals 22,340. Treat that band as a volatility boundary, not a signal. Fourth, watch change. Call OI rising by 25,000 at resistance while price stalls can strengthen the ceiling. Call OI falling by 35,000 while price rises can make a breakout more credible. Put OI rising by 25,000 while price holds can strengthen the floor, while put OI falling by 60,000 during a breakdown can weaken it. Fifth, use max pain at 22,100 as only a light expiry week bias, especially in the final 1 or 2 sessions. Finally, refresh the profile, combine it with price action and risk management, and remember that no line guarantees a trade outcome. Thanks for learning with Index Orbit. Like and subscribe for more practical market structure guides.